All right. Hey, everyone. It's Investment Tuesday. Took a week off for July 4th. Happy birthday, USA. Always a very, very, very meaningful day for me. As most of you know, I came here as a immigrant from India and became a citizen and am very proud to be an American citizen. And July 4th is always a very meaningful day because I am very, very grateful for this country, for the opportunities that it's afforded me. And yeah, if it wasn't for it, yeah, I don't know. I certainly wouldn't be here on YouTube talking to all of you. So I hope all of you had an incredible, wonderful, happy, and amazing July 4th with your family, your friends, your loved ones. And now we're back. We're back to work. The markets are open. And right before the holiday got going, President Trump's one beautiful big bill, OBBB, passed, got signed, and is now the law of the land. And so in today's video, let's take a look at what this one beautiful big bill. I think that's the right order. Or is it one big beautiful bill? It may be, yeah, I think the second one is right. One big beautiful bill. Great branding, by the way. Normally it's like, oh, budget, some 20 FY 2023. Instead, everybody was forced to use this this thing for what is the annual budget. But it's classic President Trump. Brand everything, make people refer to it in a particular way. And you have to give it to him that this passed. This is going to increase the deficit in for the current year. And that's the other thing that I want to talk about, which is that in addition to, of course, the huge funding needs that the United States already had before the one big beautiful bill, we've got now an additional, I don't know, $1 to $2 trillion that we have to now find from investors. We got to find people that want to own US 30-year bonds, US 10-year bonds, US 5-year bonds. Under 5 years, mostly people, they're willing. And in my previous YouTube videos, I've told you why, but we'll get into all of that. Let's get into some of the details, including, when you look at the one big beautiful bill, there's some clear winners, there's some clear losers. We'll look at some of that, and we're seeing some signs of, the market already reacting to that. And then let's see what happens with yields. And we'll see some market reaction, I think, to that as well. But let us feed the hungry lawyers first, which is do our disclaimer and disclosures, which is that this video and the content from ATG Digital is not investment or financial advice. It's presented to you as opinion, information, engagement, or entertainment. Whatever you choose to do with it, it is your responsibility because it is your money. Next, all ATG Digital content could have errors, oversights, or mistakes. Understand that investment operations, buying or selling a stock is an investment operation. Same thing for crypto options. They have significant risk and they could lead to the loss of your principal. So be aware. Next, the owners, employees, contractors of ATG Digital, we own, we trade, we transact in the securities that are mentioned in this video and all the content from ATG Digital. Next, we do not take money from company managements, crypto sponsors, and promoters to recommend their stocks or crypto tokens. We publish a fair amount across various media. The Substack goes out daily. The Ballman Speculating podcast goes out at least once a month. And I'm on YouTube most weeks. I wasn't on for last week. I thought of coming on, but hey, even I can use a break for July 4th, just like all of you. So I took a week off. Social media, pretty active on X. We are reasonably active on other platforms. Many of you may not know, but you can actually become a member of the Paul Mampilli uh, YouTube. You'll see that black button over there. Let me point it out. Yeah, you see the black button over there. If you hit subscribe, you can get access to this channel, and the major perk, if you will, is that you can get early access to the YouTube videos by a few hours or so. Um, and if you would like that, then join our YouTube channel by clicking on that black let me black subscribe button here, and you can then become one of our YouTube members. So you can do that, and then if you like the content here and you are interested in getting ongoing coverage of the stock picks, the market, the macro situation around the world, any other topics that affect the world of finance, investments, and money, then you can go to, I don't know why I've never shown this, but you can go to atgdigital.media. That is the website right there. You'll see there's the picture of me on ATG Digital. Go there, and we have subscriptions that begin at $9.99. All right. With all of that behind us, the one big, beautiful bill is now the law of the land, and it has some very clear winners and losers. And let's get down to this analysis, which I found on the internet, and just scroll through it. So this is a pretty good breakdown. Anything that increases the deficit is in red. Anything that decreases the deficit is in grayish black, whatever you want to call it. So you can kind of see here that where sort of like the money is being spent, and where the money is sort of like being taken back, if you will, from where it currently stood. So you can see some of the things that, I mean, I'm sure they will have some effect on spending, but it's hard to know exactly. Like here, repeal personal dependent exemption. That's 1.8 trillion, I think. Yeah. So these are big numbers. The exemption for high income states, for state and local taxes. This is a big one that people argued about. Again, I mean, it might have some implications for investments, but hard to like pinpoint it. No tax on tips. Right? I mean, this is a campaign promise that was made by President Trump. And he's followed through. No tax on overtime. Here comes some interesting ones, which is there's no tax on car loans through 2028. Hello, Carvana, right? I mean, that's a pretty good deal. I have not looked up to see. I imagine it's for car loans that are going to be taken from now on, and that's because the car business is struggling. I mean, high interest rates have really made it quite difficult to afford cars because car prices blew out post COVID because we're still behind on producing new cars. We still haven't really caught up. So, and then of course interest rates have jumped. So that is a big deal, and it doesn't say on new car loans; it just says on car loans. So everybody theoretically benefits. Uh-oh. I got the spinning wheel, which happens very rarely on Macs, but does happen. And it does happen when I'm recording these videos. This is another interesting one. Allowing expensing of factories through 2028. So this is part of the reshoring deal where Now, essentially, if you are to put up a factory, like normally you would have to depreciate the value of that factory over 15 years, maybe 20 years, which means, you get to deduct some of that value against current sales and current income. But you've got now this real benefit where the government is saying, build your factory now and expense it. In other words, if you generate any income, all the expenses that you spend this year, instead of it being parsed out over 5, 10, 15 years, you get expense it right away. So that is going to stimulate the creation of some factories and more things being built in the United States. There's the extend fuel tax credit. And then we get to see, of course, some of the things that are being debated, including by Elon Musk and Tesla, which is the repeal of the EV tax credit. Um, there's other ones out there, phase out of energy investment, which I believe is mostly was directed towards alternative energy or renewable energy. Uh, this is the um, IRA, which is the Inflation Reduction Act, various credits. Um, this de minimis is shipments to China. In other words, to try and sort of like increase the costs for imports coming in, encourage more consumption of locally made things. Um, this one is an interesting one: increase in college endowment tax. So the one big beautiful bill actually now starts to tax college endowments like the ones that Harvard has and Yale has, which is in the multi billions of dollars. I believe it's like at 8% or something like that. And I bring this up because one of the sets of stocks that we have seen bid up in the last 3 months or so, I believe, as this bill has been going through Congress, has been for-profit colleges. And for-profit colleges don't have endowments. And in theory, anyway, the endowments sort of like allow and facilitate the subsidy of students that go to these colleges. And I suppose on the margin, it sort of pushes some number of people away from these colleges and this type of college education to a more directed college education, which is what the for-profit colleges focus on. And then we've got a lot of defense spending here: shipbuilding, air superiority and missile defense and munitions and supply chain, nuclear deterrence, border security and narcotics, military intelligence. The border is fairly big, and then there's a number of things with respect to immigration enforcement. And then here we go. We got a lot of things that they'll have effects, and we'll definitely be hearing from companies in after they start reporting for the second quarter what these effects are going to be. In other words, I mean, cuts from the federal government, which is, I mean, remember, we spend an extraordinary amount of money. I mean, the total amount of this is what? Okay, so like about 8 trillion, something like that. I mean, the additions by itself are an additional 3 to 5 trillion. So cuts of this magnitude will ripple through the economy. I mean, there's just no two ways about it. I mean, when you see numbers like this coming through, 295 billion, 51 billion, 32 billion. I mean, each one of those line items is somebody's revenue, is somebody's sales. And so uh, one of the things that you will definitely see in the second quarter is companies beginning to tell you, hey, as a result of the one big beautiful bill, we are going to be lowering our guidance for 2025, and we'll likely be lowering our guidance for 2026 and 2027. And being that replacing the government as a customer is not going to be that easy. I mean, there's a reason why these companies were dependent on the government to begin with. So this is one of the things that I have been saying, which is that the markets have ripped to all-time highs. There is an extraordinary amount of optimism, which, hey, I am Mr. BOP. There's nothing wrong with optimism. You got to base it on something real, right? I mean, there's an extraordinary amount of optimism on a lot of companies. And you've got a bill here from the federal government, which is, an enormous player in the US economy. I mean, the US government is arguably the biggest player in the US economy for many different businesses, where they are definitely, looking to cut, looking to add, reprioritize, redirect um, spending, and it will definitely have an effect. I mean, there's just no question about it. Um, One of the clear effects that we have seen in the market already is alternative energy, renewable energy. I mean, stocks associated with that. Remember all like, I mean, we made a lot of money on stocks like Enphase, Solar Edge, etc. Those stocks are just cratered. So many of those and related companies have really done very, very poorly. And they, in all likelihood, will report that, hey, everything we feared is now coming true. And this sector will have to reorganize itself to sort of like wean itself off all of these tax credits, any of the help that they used to get, and find a new way to go about things. Just like, this car loans, um, this is going to benefit a number of banks. It's going to benefit, obviously, the Carvanas of the world. I imagine it benefits car dealers of various kinds. So, winners and losers, one way or the other. But the takeaway from this is that the second quarter earnings will definitely not be a sort of one size fits all happy day, because a lot of companies are definitely been affected by this bill, some in a positive way, some in a negative way, and they will start telling you about it. And unless the stock has already accounted for this, like for example, I think a lot of renewable energy stocks and alternative energy stocks, and they've been hammered for the better part of a year. Arguably, they've discounted, anticipated a lot of it. It's not a reason necessarily to go and buy them. There might be a short covering rally. However, if the news is worse than whatever's been discounted, in other words, which is what people have expected, then the stocks will take another cut. So we are to see what is going on, and the second quarter um, is definitely going to be an interesting quarter in terms of earnings reports. We had the Liberation Day announcement, then we had a crash, and then we've had a recovery with no real news, right? Well, we've had news, if you will, which is rumors and like, oh, this is going on, but we haven't had the news that matters for business. In other words, am I still growing? Can I still say that our guidance is good, or can we lift guidance? We haven't seen any of that. And we will start to see that. It's now, beginning of the third quarter. And we will start to see earnings results starting to come out, and people starting to tell you, yeah, between tariffs, between this one big, beautiful bill, um, and general inclinations by various companies, people, etc., to deal with the uncertainties around both of them, which is that we didn't know that this one big beautiful bill was going to get passed. There was significant doubt earlier this year that a bill like this would pass. So there would have been some amount of restraint by businesses who wondered, like, hey, well, if I'm not going to get, you know, the same allocation in the budget, I think I'm going to hold back a little bit, right? I mean, so that uncertainty will have been, uh, come through in the second quarter by some restraint. And then the tariffs, where I'm recording this on July 7th. The deadline is tomorrow for the rest of the world. We have a deal with Vietnam, we have a deal with the United Kingdom, and I believe that's it. So we got all these other countries, they got to make a deal theoretically in a day. I doubt that's going to happen. I saw a headline saying that they're going to send uh, letters to various countries with the tariff rates. There is an implied threat in there to go back to whatever the original rates were, which were some crazy high number. So that's still sitting out there. And I've said this from the very beginning, which is that just understand that we are going from where essentially there were no tariffs to where there are going to be tariffs. In other words, someone's got to eat, right, that tariff or lose customers, right? I mean, people can be blasé and say, well, Paul, they'll just pass on this to consumers. Consumers are very price sensitive, right? I mean, you can look at yourself. The moment you see the price of something that you used to buy go up by 5%, 10%, 20%, 30%, well, you will be like, I'm going to think about this before I buy. And that is natural. So someone's got to eat that increase. And profit margins, of course, have spiked to, essentially historic highs. Businesses, what we have seen so far, let me see if I can get up um, one of my favorite commentators. This is Wolf Street, and I recommend Wolf Street. In other words, you've got profit margins at all-time highs, which is, one of the reasons why the S&P 500, NASDAQ 100 are all at all-time highs. Yeah, I mean, who's going to eat these tariffs? It's going to be business. I mean, there is no way that consumers are going to pay 30 or 40% more. I mean, they will just simply say, no, I will just defer my consumption, or I will pick something cheaper, whatever it is. But those very high profit margins, yeah, those are going to start to get whittled away, eaten away, as people are and companies are forced to uh, to eat those tariffs. So profit margins almost certainly are at some historic peak and setting up to go down as a result of tariffs, even if the tariff news is good. In other words, even if what is negotiated is some fairly low number, somebody still has to absorb that. That higher tariff cost has to be absorbed by somebody. And with profit margins where they are, businesses are just going to be generally of the thought process, well, I would rather have a lower profit margin. Remember, they're not going to have a loss. They're just going to have a lower profit margin than lose a good customer. Because once the customer leaves and goes to a competitor, stops buying your product, stops using your service, it's much harder to get them back. I mean, it costs, customer acquisition costs, which is what marketing. Essentially, those are one of the biggest costs that you have. So this is another reason why I've been saying, and I did it in my last YouTube video, which is that this is a time to be thoughtful about risk, thoughtful about market levels, especially in the very popular stocks. The ones, Nvidia and all of those that everybody, is very excited about because they've ripped higher. Just remember, between the crash and now, we've gotten no earnings, no sales, nothing. It's all been essentially what I'll call, I mean, it's non-fundamental news. In other words, it's just people, the price is what is making people buy more. In other words, no one wants to be left out, so they're buying more. However, the macro scenario is that the tariff news, even under good circumstances, is still going to mean lower profit margins for any company that is affected by it, which is pretty much everybody, right? Unless you exclusively manufacture in the United States. It's pretty much everybody. Second, we've got the one big beautiful bill, which has winners and losers. And then finally, I want to put this up, which is what I talked about last week, which is like, how are we going to pay for this? Right? I mean, all of my searches using Grok, etc., say that we need somewhere in the range of 8 to 9, maybe $10 trillion between now and year end. I mean, that seems like a crazy number to me. Like, I almost don't want to believe that that's possible. Like, between now and year end, we need $8 or $9 trillion, essentially just to keep the U.S. government functioning, right? I mean, $8 to $9 trillion. And my question, actually, let me put this one up before I put up that one, which is that at these rates, right? In other words, you can lend your hard earned money to the US government and get 4.2%, and they will pay you that for a 30-day time period, not 30 days, 30 days to 90 days, 4.2%. Or you can give it to them for 10 years and get 4.3%. Yeah, I don't think it takes like a genius to think like, I don't really think I want to give my money over in the current environment where we have 36, $37 trillion in debt. We've got a deficit that is going to be rising. We've got compressed yield spreads. I mean, the short-term yield, which is 30 to 90-day treasury bills, is 4.2, 10 years at 4.3, 30 years at 4.9. Are you really being paid enough to take on the risk that your money, if you lend it to the US government, sure, they'll give it back to you because we can print dollars, we can issue dollars to our heart's content, essentially. But what about inflation? I mean, is the value of this money going to be anywhere near what it is today when I get it back 10 years from now, when I get it back 30 years from now? And my view has been, which is that just I don't need to be like the most complicated bond trader. I just think 4.2% for 30 days and 4.9% for 30 years in the current environment, which is of what? 36, $37 trillion worth of debt, huge deficit. We've already seen, a huge spike in inflation in 2021, 22. We've never been able to reverse that. While current inflation is low, we are nowhere near getting back to where we were in 2019. In that scenario, can I find, someone that, has $300-400 billion, $500 billion that they want to throw into the 30-year yield at 30-year bond at 4.9%? Do you want to lend your money to the government for 4.9% for 30 years? I don't want to. I mean, I'm a patriotic guy. I still, use financial logic and calculation when I make my investments. And 4.9%, in my judgment, in my view, is simply not enough. So one of two things can happen, which is that, and this is you can hear it in the politics already, which is that we need short-term yields to go down, which would then increase the spread. So imagine that Let me just increase the size of this. Oops, too big, too small. Okay, so imagine that the short term yields, which is for 30 days to 90 days, imagine this was round number 2%, and everything else remained the same. Well, hey, that would be a pretty good deal. Now I'd be like, okay, well, hey, the the 30-day treasury bill is 2%, and and the 30-year is 5%. That's plus 3%. Okay, I think that's nice and thick and juicy. I think I'll take that, and many investors would. Let's say in that scenario, the 10-year bond is at four, whatever, 4.2, 4.1. That's still, over 2%. I think there's a lot of takers at that spread. However, we've got this face off between the head of the Federal Reserve was Jerome Powell and President Trump and his Secretary Bessent and others in his administration that are trying to get Powell to cut short-term interest rates for this reason, I believe, which is that they're aware, like, hey, this spread is not helping, right? This spread is not helping. They need the difference between the 30-year and the 10-year to be much wider than it is today from short-term yields. And the Federal Reserve, they can definitely affect this, right? Which is why you hear President Trump constantly talking about Jerome Powell. Now, I mean, what would happen if the Federal Reserve cut rates? My sense is that, just given from watching, what's going on in the bond market, my sense is that if the Federal Reserve cut rates today, the 10-year bond and the 30-year bond would blow out by 0.5%, 1%, which, just so you know, is a big deal. In other words, from 4.3, 4.4, let's just round it out to 4.5%. The 10-year bond would go to 5%, and let's round out the 30-year yield to about 4.9. We round out to 5%. It would go to 6%. It would blow out. Why? Because the bond market is not persuaded, is not convinced that long-term inflation is under control. Why? Well, we're not back to where we were in 2019. I mean, the money that has been issued by the Federal Reserve, I mean, they pushed, I think, 30% of all the dollars or something like that ever in existence was, issued in 2020, 2021. That really hasn't, sort of like been corralled back in. Government spending, of course, is nowhere near what it was in 2019. I mean, we've blown all that out. So they're not persuaded that long-term inflation is under control. Short-term and maybe medium-term inflation, they're more persuaded about, which is why I believe you're seeing this unusual yield curve. So, I mean, here is the various interest rates for different time periods. Here it is for 1 month, which is 4.3%. For 2 months, 4.5%. But then you see it goes down as you get to the 2-year mark. In other words, the bond market is persuaded that shortish to medium termish inflation is kind of under control, but then it starts to lift back up at the 5-year and 10-year mark and 30-year mark, which is why we have this kinked yield curve where there's this split judgments between there. What's the sort of like bottom line here, and why bother with all of this kind of analysis? Which is that if the Federal Reserve cuts, I think long-term interest rates blow out, you have a very steep yield curve. All right. That's a kind of good scenario. That would be the smoothest scenario because that would be somewhat under control. Now, there is a more disruptive scenario. In other words, where the US government goes to sell 10-year bonds, 30-year bonds, and they run out of buyers somewhere near the current rates, which is, let's say, around 4.2, 4.9%. And then you have a sudden jump where the 30-year suddenly has to jumps to 5.3 or 5.4%, or 5.5%. And that takes up, of course, the 10-year by like whatever, another 0.5%. That, of course, reprices all other bonds, corporate bonds, and municipal bonds, mortgage bonds, all bonds then reflect this pricing, which in turn, of course, affects the pricing of all assets. Any company where their, let's say, where their biggest earnings are 3 or 4 or 5 years out, the investors will be like, well, I mean, hey, if yields are going up, it can be only for one reason, which is that in long-term inflation is going up. That's why bond investors want to be compensated. They want to be paid. So in that scenario, look, those peak earnings, those peak sales, 5, 7, 10 years, it's not worth as much. Money's worth less and less into the future. Your stock price needs to go down. So there would be a whole repricing that happened across all assets if this occurred. The thing is that we are in between these worlds. I mean, it's possible for the U.S. government to sort of like just keep issuing um, treasury bills, 4.2%, 4.3, 4.4.5%, because there's plenty of demand. No one questions the ability of the U.S. government to issue the dollar, and where people will be like, I'm happy to lend for 30 days, 60 days, um, yeah, all the way out to about 6 months. And you give me 4.3%, that gives me enough flexibility where, hey, if inflation spikes, if the long bond blows out to 5.5, 6%, as Paul Billy says, I can, take my money and go get that big yield. So there's plenty of demand here. And the issue here is like they need, if you've got a $36 trillion, $37 trillion debt, and you've got 20, 30% of it coming due over the next 6 to 12 months, you got to sell some 30-year bonds. You got to sell some 10-year bonds. You can't fund all of it here. You got to fund some of it over here. The question is, at what interest rate? If this doesn't move down, to 2%, and we don't get a nice straight up yield curve, this moving higher would be very disruptive to the bond market, would be very disruptive to the stock market, would be disruptive to pretty much all asset markets, because interest rates are the critical ingredient factor in the valuation of all assets. Okay, so bottom line to this is that I am repeating what I have said last week, which is that we're in a unusual moment. We've got stock prices at all-time highs. We've got bond prices not reflecting a lot of risk. We've got asset prices in general reflecting not a lot of risk, as there are a number of significant uncertainties, risks that, I mean, I don't think it takes a genius to see these, right? I mean, it's a lot of it is common sense. I mean, do you want to lend the government, for 30 days at 4.3% or 10 years at 4.3%? I mean, it doesn't take any genius to figure this out, right? I mean, there's just not a lot of buyers for 10 years unless everyone thought that, short-term interest rates are going to go down. Then they would run and take 4.3% for 10 years because they're like, hey, because markets will chase yield. I mean, at any time. But at current rates, it's not there. And the economy continues to be strong, right? I mean, employment is strong. There is no real sign of like economic weakness. And it's not like the federal government is slashing spending. So there's not going to be a recession as a result of the one big, beautiful bill. That, they're going to continue to, still spend a lot of money. So that's going to push itself through the economy. So there's no real sign of a recession. There's no real sign of an unemployment spike. So there's no real reason by which the Federal Reserve really can cut interest rates, inflation, while it is lower than it's been, is certainly not, back to 2019. We're not experiencing deflation. It's still between 2 and 3%. And the price action on gold, the price action on Bitcoin, truthfully, the price action on the 30-year bond, and that's the one to watch. Watch the 30-year bond, is telling you that, people think that, hey, you're not going to see inflation really dip much. It's not going to go below 2%. It's going to hover between 2 and 3 and percent or so. In that scenario, what's going to happen? What's going to happen here? Will you see a scenario in which rates get cut where you get, let's call it the good scenario? In other words, the Federal Reserve cuts rates on the, so the 3-month Treasury bill is at 2%. And now the 30-year at 5%, the 10-year at 4.5%, everything just makes beautiful sense. Everything's wonderful. Everything's hunky dory. Or, variations of other scenarios where, things, if they happen very quickly, then you'd have, I don't know, maybe another like mini crash, like what happened uh, with Liberation Day. If it happens slowly, then the impact on various industries and sectors. But let's say the 30-year bond lifts to another high. I mean, it's 5.1% was the high that was set during Liberation Day. It goes to 5.3, 5.4%. In other words, the kind of like a ratchet type, like lifting of yields. And just remember, the Federal Reserve does not control interest rates. It only controls one interest rate. That is called the Fed funds rate. So it can't necessarily make the 30-year bond do anything. It can't make the 10-year bond do anything. Those are all set by buyers and sellers coming to bid for bonds. So if there was a ratcheting up of long-term interest rates, that would definitely not be good for the prices of all bonds, the prices of most assets, because again, common sense, if you can get 6% for the 30-year treasury, there's a lot of people be like, you know what? Yeah, it's not 12% in equities, but there's no risk here. There's no default risk. Yeah, I take on inflation risk, but there's inflation risk in the stock market too. I mean, yeah, it's not like that's risk free from that. So it's simply as interest rates go up, the need, the desire, the financial logic to be in any risky asset, whether it be stocks, whether it be real estate, um, just simply goes down, because interest rates, they're like the free lunch. You can get something for nothing. You leave your money in the bank and you get whatever. Right now, if you put your money in a money market account, you get 4%. Pretty good. I mean, because the 4% is there, you don't have to worry about the stock market. You don't have to worry about the bond market. You have to worry about the macro situation of the world. It's always there. So that represents, of course, an attractive alternative. That is a challenge, especially given where markets are. Last week, I said, like, if we were at the Liberation Day lows, which is approximately 20-25% lower, in terms of the S&P 500, in terms of the NASDAQ 100, you could say, you know what, some of this risk is priced in. But we are at all-time highs. I mean, essentially, we just had a crash and like a rocket ride up, with no real substantial reason for it. In other words, just purely speculative demand, price driving more price, which is driving demand, right? Now, I am not expecting a crash. I think the most likely scenario, just given everything, is a ratcheting up of the long-term treasury rates, which starts to squeeze various markets one at a time. That's just my sense and my feel from having been in markets for 30 years. I just don't get the sense that people want to sell. Generally, a crash generally comes when there's like this nervousness that's there, and it's driven oftentimes by the fact that people have extended themselves in a big way. Now, that's not a guarantee, just that's my sense that there's still a lot of money, like sort of like floating around in markets, and so the most likely scenario, I believe, is that you will start to see the 30-year bond ratchet higher, take the 10-year bond with it. That will, start to hit a number of industries that need, cheaper long-term financing. Over time, what it will do is definitely there will be dislocation in some parts of the market. That's just my sense, but it's completely possible that we could also have like a very rapid like jump. I mean, if interest rates jumped from if 30-year bond jumped from 4.9% to 5.5% in one auction or in 1 week, well, I mean that would be quite different. But if it just went up by 0.1%, 0.2% in an up and down way, then markets would just sort of like hover around, and you would have sort of like some set of stocks just get like taken out, and and just like taken to the woodshed, and then you'd get another set of stocks that were affected by the next sort of like increase, get taken out the woodshed. But through this period there are going to be stocks that go up, because this scenario is where the federal government is still spending and it is still pushing money into various areas. So there's going to be no recession as a result of the federal government having cut. Um, Interest rates are not so high. I mean, they're not at 10 or 11%, right? Where, it would be devastating across the board. At current rates, 0.1%, 0.2% higher, just, in a small ratchet way, would not cause immediate reactions. And remember, companies don't have all their debt coming due on one day or 1 week or 1 month. I mean, they comes due over time. So people will make different bets. Some people will be like, you know what, yeah, interest rates have spiked up, I'm going to wait to refinance. Others will be like, hey, you know what, I don't want to take the risk, I don't be there, so I'm going to eat the higher interest rate expense. And then there's the issues with tariffs. Bottom line to it, that if you look at prices of the S&P 500, the popular stocks, the Nvidias of the world, you would imagine that, it's just clear sailing. I'm a BOP guy, and I just tell you, yeah, I am BOP on our stocks, which, are sort of built around the idea that this is a more difficult environment. And you need to be choosy, you need to be picky, and you need to be thoughtful about risk, and stock selection and industry selection. And if you're looking for guidance like that, well, hey, ATG Digital is where you go. Subscriptions begin at $9.99. All right, that is Investment Tuesday for today. Next week, we will feature some stocks that benefit from this scenario. That whatever occurs, there's always winners, right? I mean, there's always winners. And they always come, in ways from places that people don't expect. So we'll feature some of those. So stay tuned and come back next week for Investment Tuesday. With that, that's me saying thank you and goodbye.